that changed the course of Berkshire forever. And let's say both of these companies start at an earnings per share of $1, outperformed by a pretty substantial margin, almost 200% outperformance. So which companies would make the list today?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
From 1965 to 2022, Berkshire Hathaway has compounded annual growth at 19.8%, compared with 9.9% for the S&P 500 over that same time period. Warren Buffett largely gets credited with this incredible performance. However, it was really his business partner, Charlie Munger, who taught Buffett one thing that changed the course of Berkshire forever. In this video, I'm going to explain what that concept is. Then I'm going to backtest that concept from 2003 to 2023. And then at the end of the video, I'm going to share the 10 largest companies in the S&P 500 that meet this particular criteria. Since Charlie Munger passed away several weeks ago, there have been all kinds of videos made on his life, all kinds of articles written on famous quotes, but there's one quote that I think distills the very essence of Munger's investment philosophy, and I think this is the biggest contributor to Warren Buffett and Charlie Munger's success managing Berkshire Hathaway. Over the long term, emphasis on long, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return. Even if you originally buy it at a huge discount, conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one fine result. To illustrate, let's say we have two different companies and we're going to plot this company's earnings per share on the top axis, and then on the bottom axis, we're going to have time. And let's say both of these companies start at an earnings per share of $1. And we're going to look at each of these businesses over the course of multiple decades. So we're going to have 10 years, 20 years, 30 years, and 40 years. So let's start with the first business, which we're going to say is the 6% compounder. And for simplicity's sake, we're going to say that each one of these companies is reinvesting 100% of their earnings back into the business. So for every $1 that they reinvest, they earn a 6% return in the next year. So for example, starting at $1 earnings, the next year, this company would earn $1.06. The year after that, they would earn $1.12. So after 10 years, this company would be earning $1.79. So we'll put that here, $1.79. After 20 years, the company would be earning $3.20. After 30 years, they'd be earning $5.74. And after 40 years, $10.29. Now let's consider the 18% compounder. So this company also starts at $1 per share. After 10 years, they would be earning $5.22. After 20 years, they would earn $27.40. And clearly my chart is not going to be big enough. After 30 years, they would be off the charts at $143. And then after 40 years, they would earn a staggering $750 per share. So even if we assume after 40 years that this company would trade at a pretty cheap multiple, say 10 times earnings, the stock price would be trading at $7,500. You could have paid $165 per share all the way back here in year number 1. If you had paid $165, you would have still earned a 10% annual rate of return on the stock for 40 years, ultimately reaching $7,500. And if we divide $165 by the current $1 per share, you can see that you could have paid a 165 times multiple for this stock. It could have gone to a 10 multiple in the future, and you still would have earned a 10% annual rate of return. So this is what Charlie Munger means when he says that you can pay an expensive looking price today. We'd all agree that 165 is a very expensive price to earnings ratio. However, that would have been more than justified. Why? Because the company was able to reinvest at such a high rate of return for so long that you still would have made a 10% annual return on your investment. So I decided to put this concept to the test. What happens if we run a backtest and compare two different strategies? In the first strategy, we buy all the stocks that have a return on capital of at least 18%. In the other strategy, we buy all the stocks that have a return on invested capital of less than 6%. I went back to January 1st of 2003 and I bought all 91 stocks in the S&P 500 that had a return on capital of 6% or less. I'll show you the list of those companies here in just a minute. Throughout this test, I reinvested 100% of the dividends paid back into that stock. So for example, if AT&T paid a dividend of $1 per share, we reinvested that back and bought more AT&T stock. I also never sold anything. The only time we sold something was when you had cash enter the account, either via a spinoff or maybe an acquisition that was done in cash. And anytime cash entered the account, we reinvested that into the next highest return on capital stock, as long as it had a no greater than a 6% return on capital. This is also assuming there are no taxes, fees, or any other trading costs. I did incorporate the initial bid-ask spread estimate into my study. Here is the list of top 20 stocks. I just sorted them by market cap as of January 1st, 2023. So if we had bought that portfolio and then reinvested all dividends and any cash in the next highest scoring name, this would be the total return performance. So in the red line, we have the model portfolio, so this hypothetical portfolio of 90 stocks. And the blue line, we have the benchmark, which I've made the S&P 500 index. All the stocks were started out at an equal weighted, so I just took 1 divided by 91, and that was the weighting for each stock at the start. And as of December 20th, 2023, this portfolio had still produced a total return of 660%. That equates to a 10.2% annual return. And then we also have the maximum drawdown, which tells us top to bottom how much did this strategy fall in the worst period, which was 63.2%. That compares with the S&P 500 at 55%. And if we look at more recent years, so this is just showing us the last 10 years, we can see how the strategy would have done each and every year. We can also see some metrics such as dividend yield, beta, so this has a slightly higher beta than the S&P 500. Sharpe ratio is worse, Sortino ratio is also worse. And you can see all the other risk metrics like standard deviation, downside deviation, and max drawdown are worse than the S&P 500 index. These were all the stocks that were held the entire time. So we bought them from the very beginning and held them throughout. And what you'll find is a common characteristic of what I call the coffee can portfolio. And that is you've got several companies that just produced absolutely terrible results. So even for that 20-year period, Bank of America is lower today than it was then. H-bond is as well, and so is Key. Those all produced total returns somewhere between -5 in Bank of America's case, all the way to -44 in Key's case. The starting portfolio value was assumed to be $100,000 in both cases, and what you'll find is that several of them, all these losers, started off at, we'll say, roughly $1,000, a little bit more than $1,000, and at the end, these are all worth less than what you paid for them. However, you'll notice there are several just absolute massive winners. So for example, CMI, Cummins, produced a 3,293% total return, so your $1,000 roughly investment would have grew to $37,167. So despite having several of these big losing positions, you also had several just absolute massive winners. So at the end of 20 years, you'd have had this kind of strange portfolio construction where your weightings that started out each at just around 1% each stock are now pretty highly distorted. So this would be the top 10 holdings as of December 20th. You can see that the best performing stock, which was Cummins, is now weighted at 5%. So the winners continue to win, and they became a more and more important part of the portfolio. Meanwhile, the losers kept losing and became a decreasingly important part of the portfolio. So now let's take a look at what would have happened if you would have, instead of buying the 6% or less compounders, you would have bought Charlie Munger's 18% compounders. Again, I looked at the S&P 500 following the exact same methodology, only I was only buying companies with an 18% or greater return on capital at January 1st, 2003. There were 80 stocks at the time, and I followed all the exact same portfolio management criteria. These were the top 20 market cap holdings at the time. So if we had bought all 80 of these, this would have been our result. So the model portfolio is here in red. The benchmark, or the S&P 500, is here in blue. And now, instead of underperforming the S&P 500, we have now outperformed by a pretty substantial margin, almost 200% outperformance. This portfolio generated an annual return of 11.6%, so didn't quite match up with Charlie Munger's prediction that it would roughly equal 18%. However, it is clearly moving in that direction. The other thing to note is that not all of these companies that started with a really high return on capital ended up that way. So that's one of the big tricks, is figuring out not just which companies have high returns on capital, but which companies can maintain that and continue reinvesting at those rates for many years to come. But importantly, we see that the maximum drawdown is now significantly less than the lower returns on capital portfolio. We're at 46% compared with 63% for the lower returns on capital and 55% for the S&P 500. You can take a look at more recent time periods, and you can see that this portfolio has continued to outperform over time. But we also see favorable Sharpe ratios. This portfolio has generated outperformance and done it with a lower beta than the S&P 500, so higher returns with less risk. This portfolio had quite a few more stocks that were held the entire time. And we also see the same exact phenomenon, only this time, rather than having 3 losing positions, we only had 1, which was Walgreens at negative 13%. We see the same thing with the initial investment. In this case, it would have been about $1,250 invested into each one of the 80. But the Adobe position would have grown to $59,254, by far the best performing position. The exact same thing happened to the weighting. You can see Adobe, which is actually the second highest weighting in the portfolio, was 6%. The highest weighting was AutoZone. That one was only held for 6,942 days. So this took the place of something that was purchased or spun off. That one actually grew to be the largest position, but all of the top 10 holdings grew from $1,250 to over $20,000 in the end. So which companies would make the list today? Here are the top 10 companies in the S&P 500 that all have returns on capital averaged over the last 5 years of at least 18% or more. I've ranked these all by highest market cap to lowest, so you'll see a lot of familiar names on the list. Thank you to everyone who is currently supporting me on Patreon and YouTube. All supporters will get access to the entire list of companies that have returns on capital in excess of 18%. I also just posted my coffee can 30 buys for the month of December. The idea is to see, is it possible to outperform the S&P 500 by doing absolutely nothing? It's an interesting experiment. I'm following along right with you, and I will post performance on how that portfolio is doing. So if you're interested in checking that out, you can do that with the link in the description down below. Thanks for watching the video, and I will see you in the next one.